Hello everyone, and welcome to our session on some critical financial metrics we use in our e-commerce campaigns. Just like any successful endeavor, whether it's sports or academics, understanding the foundational elements is crucial. Knowing your numbers isn't just good practice, it's everything. It empowers you to make informed decisions and confidently navigate your business journey. Today, we'll dive into 7 core financial metrics that are absolutely essential. These include revenue, cost of goods sold, net profit, gross profit margin, return on investment, inventory turnover, and cash flow. While this list is comprehensive, the financial landscape can evolve, and we'll always keep you updated on any new metrics that become vital. Financial metrics are the bedrock of sound business decisions, so let's get started. Our first metric is revenue, often interchangeably called sales or the top line. These terms all refer to the total amount of money your business generates from selling products. It's the grand total before any expenses are considered. However, it's critical to understand that revenue is often a vanity metric. While impressive, a high revenue figure doesn't necessarily mean high profitability. Consider this: a business with $1 million in revenue, but only a 1% profit margin takes home just $10,000. Conversely, a business with $500,000 in revenue, but a robust 50% profit margin pockets $250,000. This stark difference highlights that revenue tells you how big a company appears to be, but it doesn't reveal its true financial health or what the owner actually takes home. In other words, revenue indicates sales volume, but not actual profitability. Next up is cost of goods sold. This is the per unit cost of your product once it's ready to be sold. It encompasses all direct costs associated with bringing that product to market. This includes the manufacturing or purchase price of the item itself, shipping and freight charges to get it to the warehouse, packaging, labeling, and any preparation services required before it reaches fulfillment centers. Of course, digital offers have a relatively minor cost when compared to physical products. Accurately calculating your COGS is paramount. It forms the fundamental basis for all your financial reporting and, more importantly, for your strategic business decisions. Without a precise understanding of your landed cost per unit, it's impossible to set competitive prices or accurately forecast profitability. Now, let's talk about net profit, everyone's favorite metric, especially when it's positive. Net profit represents the actual take-home dollar amount you're left with after all business expenses, including your cost of goods sold, have been accounted for. It's the ultimate measure of your business's financial success since it's the final amount of money earned after all costs are deducted. To illustrate, if you purchase an item for $2 and sell it for $5, your net profit per item is $3. The formula is straightforward. Total revenue minus all your total expenses equals your net profit. This is the money that truly belongs to you and your business, available for reinvestment, savings, or personal income. It's the bottom line that truly matters. Moving on to gross profit margin. While often confused with net profit margin, gross profit margin specifically measures the percentage of revenue remaining after deducting only the direct costs of producing your goods, that is, your COGS. It's calculated by taking your net profit, dividing it by your revenue, and then multiplying by 100 to get a percentage. Using our previous example, if you have a $3 profit from a $5 sale, your gross profit margin is 60%. This metric is crucial because higher margins provide more flexibility. They allow you to break even faster on your initial investment and give you more room to cover overhead expenses like staff salaries. A healthy gross profit margin typically starts around 20% and goes upwards, providing a buffer against market fluctuations and operational costs. So, gross profit margin indicates product-level profitability before operating expenses. Return on investment, or ROI, is a powerful metric that tells you how much money you earn for every dollar you invest. It's expressed as a percentage and is calculated by dividing your net profit by your cost of goods sold, then multiplying by 100. A high ROI is a significant accelerator for business growth. Let's look at 2 scenarios. If you buy an item for $5 and sell it for $10, generating a $5 profit, your ROI is 100%. This means you've doubled your money. If you buy an item for $8 and sell it for $10, with a $2 profit, your ROI is 25%. While 25% is still good, 100% is clearly better. The higher your ROI, the faster your capital multiplies. This metric is particularly vital when making purchasing decisions, as it directly impacts how quickly your business can scale and generate wealth, often outperforming traditional investments like the stock market on a compounded monthly basis. In sum, ROI measures the efficiency of an investment, showing how much profit is generated per dollar invested. Inventory turnover is a ratio that reveals how frequently you sell through your entire inventory within a specific period. It's calculated by dividing your cost of goods sold by your average inventory value. This metric is crucial for understanding the velocity of your sales. Think about it. What's better, a product with a 100% ROI that takes a year to sell, or a product with a 10% ROI that sells out every month? The latter, with its faster inventory turnover, often generates more income in the long run because your capital is constantly being reinvested. High turnover means faster cash flow and reduced storage fees, while low turnover can tie up capital and potentially lead to losses if prices need to be cut. Balancing a healthy ROI with an efficient inventory turnover rate is key to sustainable growth and maximizing your profits. We see that inventory turnover measures how quickly inventory is sold, impacting cash flow and profitability. Finally, we arrive at cash flow, the lifeblood of any business. Cash flow is simply the amount of money you have available each month to operate your business. It's profoundly influenced by your ROI, profit margins, and inventory turnover rates. Positive cash flow is essential for covering fixed costs like employee salaries, software subscriptions, and other operational expenses. Without sufficient cash flow, your business can quickly find itself in a precarious position, unable to pay its bills or fund future growth. For instance, if you're planning a large purchase order, but it takes several months for that inventory to sell, you need enough cash flow to bridge that gap. Similarly, investing in research and development for new products can temporarily reduce cash flow, which is a normal part of business growth. The healthier your ROI and profit margins, and the faster your inventory turns over, the more robust your cash flow will be, providing you with the financial flexibility to seize opportunities and navigate challenges. So, to conclude, cash flow is the available money to run the business, driven by ROI, profit margins, and inventory turnover. And there we have an overview of some of the most critical related financial metrics we need to monitor for both success and failure in our e-commerce campaigns.